Ahead of the Asian Development Bank annual meeting in Frankfurt this year, I speak to David Mann, Chief Economist Asia for Standard Chartered, about the economic outlook in Asia and especially the trade links and investment links between Asia and Europe. David, thank you so much for joining us.
Thank you.
So first off, I know that Standard Chartered has recently published a report looking at the Asian region and at leverage levels across the regions. You also published something similar years back, also in 2013. In terms of the latest findings and developments in the last couple of years, what can you tell us?
Well, the first thing is the number one area of concern for us in Asia has remained the same. It's China. And actually, now that we've gone more to the end of the credit boom there, actually the risks are still there, if not slightly bigger than they were before. As you start to slow, think about it like riding a bicycle. As you slow speed down, that's when more of the shakiness can creep in. Another area for us, in the top areas of concern for us beyond China, is Japan and Malaysia, as well as Hong Kong. Now, in the case of Hong Kong, it's mainly actually been because of a pickup in credit growth of late to grow even faster in excess of GDP growth than even China has been. And of course, we know that Hong Kong is an area that has a lot of source of credit that goes for outside of Hong Kong. But of course, unfortunately, that's going directly to our biggest area of concern, China.
Mm-hmm. And in terms of household debt specifically, Malaysia, for example, is a country that stands out for the speed of increase in household debt of late. What do you think about this country in particular?
Well, that's absolutely right. And I think on top of that increased pace that we've seen, regardless actually of a lot of the macroprudential measures taken to try and keep it under control, we actually are also worried about the fact that the debt service ratio has now risen to a level as high as it was in the US pre-crisis. And this, as a combination of things, now that it's started to slow down a bit, tells us that at best, you should expect weaker growth in Malaysia's household sector. And at worst, there could be the risk of crisis. I'd say one thing working in Malaysia's favor, though, is unlike the US, you don't have those weapons of financial mass destruction ready. And I think that's the good news actually around the whole region, that you don't have those same sorts of structures created that can come down like a house of cards.
I guess there's the financial sector and the banking sectors in the region have been quite conservative after the Asian financial crisis.
Absolutely right. And I think the other good news is that when we look, for example, on government debt around the region, even in the case of China, actually, even including all of the local government debt, the central government actually still has plenty room to be able to stimulate growth and increase debt if needed. And it's what we're seeing this year, a much more adventurous use of fiscal policy in China to support GDP growth.
And speaking of China, of course, the big talk in 2015 and again this year has been the economic slowdown. I guess it is a new normal, as many have said. In terms of the effect that this is having on specific countries in the region, which markets do you think have been hit the hardest from this change of pace in economic growth in China?
Well, I'd say firstly, it's those, even if you don't have it as your biggest partner, and usually China is the biggest partner for most in the region, I'd put it into two categories. The first one would be those affected by the drop in commodity prices. And in that regard, Malaysia, Indonesia have been quite hard hit, though actually we're expecting, alongside China's growth being resilient, that actually commodity prices will also be rebounding through this year, particularly your energy. The other category is in those economies up in Northeast Asia that are even closer linked to China, that also have suffered from some import substitution, particularly of intermediate goods, where China is able to make more of it itself rather than buying it from outside. So in that way, I'm thinking particularly of, say, Korea. Now, there is, however, one big difference, though, and in terms of the impact on the region, certainly it is big, but there's also a positive here, and this is on the consumption side, particularly on tourism. There's actually been quite a big pickup that we've seen on helping growth in the rest of the region from tourists coming from China. Good examples being even Japan, such a large economy that already has seen an impact, but Thailand's included, and I think there's a couple of others that are going to, in future years, start to benefit more from China's consumer side, which is still growing at a decent pace.
And although, of course, China is a big player in the region and it is so interlinked to many other countries in the region, you also wrote a note recently talking about how we shouldn't really forget that the euro area is fundamental for a lot of these markets in Asia. And actually, this will be a big theme at the ADB meeting. But in the light of slowing growth in EU, also the negative side effects of QE in a lot of emerging markets in Asia. How do you evaluate the relationship between Europe and Asia at the moment?
Well, I think it's absolutely right. The scale of the relationship is big, but the momentum is not quite so big. So, for example, even if there were the same sensitivity that there is for countries in Asia to a 1 percentage point change in growth in either the EU or in China, or for that matter, the US, the difference is that China is growing 3+ times faster than those. If we were to see at whatever point, and I'm not sure how soon that is, a pickup, a serious pickup in growth in Europe, then because the scale is there, you can get the momentum back. But I think the big question, and I think it's a fair one, is when and if, especially given all the challenges that Europe faces and the sluggish growth, even in the face of this aggressive monetary policy easing. I think for that, you need to see a lot more reform, and you need to see, I think, a much stronger performance in terms of the trade relationship leading into even more investment relationships. And I think actually you may end up still seeing a lot more of the investment flow actually going from emerging markets in Asia out into Europe. But by a similar rationale, actually a lot, I think, of the financial investment, the portfolio type investment, will start to go a lot more into Asia, especially as the capital markets in China start to take off quite aggressively. And I'm thinking mainly on the fixed income side.
And especially as investors keep on chasing yield more towards emerging markets and Asia side of the world.
Absolutely.
Perfect. Well, David, thanks so much for joining us, and I'm sure these topics will be discussed in Frankfurt as well. Thank you.
Thank you.